Hey everyone, in this video we're going over Best Buy stock. We're going to do a stock analysis. We are going to give a 5-year price target, where we think it'll be then and what we think we should pay for it now. But before we get into it, if you could smash the like button, it really helps the YouTube algorithm, and if you haven't subscribed to the channel, definitely subscribe. And as a reminder, we will be giving away a pair of AirPods when we hit 2,000 subs. Now, getting to Best Buy. They have consistently beat earnings expectations. As you can see on this chart, basically, they've constantly beat earnings, and in the more recent quarters, they have basically destroyed the expectations. I'm expecting that in November on Q4 earnings, we are going to get another beat. So I'm looking forward to that, but obviously time will tell, and we'll make a video on those earnings as well. When it comes to price to earnings, they are currently trading for a PE of 11.15. This is disgustingly low. Now, they do have a higher forward PE of around 15, and that makes a lot more sense to have a PE for around 15 for a company like Best Buy than 11. But assuming that their revenue and their earnings continue to be strong, then that forward PE could be wrong, and we are trading with a pretty low PE. Now, their current price to sales is only 0.54. Now, I expected it to be low since it is a retail business and they do have low margins. That said, it is very cheap and obviously much cheaper than the price to sales ratio of the average company in the S&P 500. Now, when it does come to margins, their margins have been improving quarter over quarter. So I'm excited to see that their margins are around 6.7% when we're talking about operating margins, and they have been steadily increasing. I'm hoping to see that continue, but the overall trend seems to be to the upside. Now, the next thing we're going to go over is net income. This is all in millions. Now, Q1 of 2020 had $159 million of net income, compared to Q1 2021 had $595 million in net income. Q2 of 2020 was $432 million, and Q2 in 2021, more recently, we just had $734 million of net income. So massive increases in the net income space. Now, I do want to point out this is comparing to a year where a lot of things were curbside pickup, etc. That said, they did mention, though, if you compare it to 2019 levels, the most recent earnings are still about 20% higher. So earnings have been going up very, very well. The next thing I just want to show you is dividends. They do have a dividend. It's a trailing dividend of 2.4% and a forward dividend of around 2.5%, but it's a healthy payout ratio. They have a payout ratio of about 25%, so they are more than capable of paying out this dividend and having plenty of other cash for buybacks and to basically R&D and future investments for their company. As far as the balance sheet, total cash on hand is $4.4 billion, whereas total debt is $4.1 billion. So Best Buy has more cash than debt. As far as assets, total assets at $18.5 billion and total liabilities at $14.2 billion, so greater assets than liabilities. Balance sheet is basically in great shape, and I expect it to continue to be in great shape going forward since they do have nice cash flow. Now, when it comes to buybacks and shares outstanding, this company has year over year consistently reduced their share count. So they are buying back shares. If we look at their most recent earnings report, we see here it says in Q2 of fiscal year 2022, which is basically this recent Q2, the company returned a total of $571 million to shareholders through share repurchases of $396 million and dividends of $175 million. They are purchasing shares more than they are giving in dividends. That is a great thing. They believe in their stock. They are buying back stock. So that's great to see that they reduce the share count, which is great for you because that makes each one of your shares that much more valuable. Now, over the long term, this company looks like it's in great shape. The CEO made these remarks. Over the longer term, we are fundamentally in a stronger position than we expected just 2 years ago. There has been dramatic and structural increase in the need for technology. We now serve a much larger install base of consumer electronics with customers who are in an elevated appetite to upgrade due to constant technology innovation and needs that reflect permanent life changes like hybrid work and streaming entertainment content. Our unique omni-channel assets, including our ability to inspire what is possible across the breadth of consumer electronic products, as well as our ability to keep it all working together, the way customers want, truly differentiate us going forward in this new landscape. Now, the thing I think about is that everything is becoming smart, so things you wouldn't normally think to buy at Best Buy, you may now buy at Best Buy. For example, light bulbs. You wouldn't normally buy a light bulb at Best Buy, but now when there are smart lights that you can control with your smart devices, that you can change colors of, those are things you're buying at Best Buy now. So lots and lots of great things ahead as more and more things become smart and they become technology products. As far as the stock price is currently $109.56 a share. It's up 9% on the year. So we have to make some key assumptions to decide if this is a stock to buy. My assumptions are a 5-year model. The revenue growth I'm expecting is 3 to 5% per year. Historically, it has been higher than that. Share buybacks, I'm expecting to continue around 3 to 5% of share buybacks. Average over the past 5 years has been 5.7%. Profit margins I'm expecting to range between 3.8% to 5.8%. In the past year, it was 4.9%. The future PE in 5 years from now, I'm expecting to be between 13 at the worst case and 15 on the high case. So I think that these are pretty reasonable assumptions. And if we use these assumptions in 5 years, it would calculate to a price target of 193 a share to 388 a share, depending on the low assumptions versus the high assumptions. And that basically means that today, I think you should pay around 120 a share to as much as 240 a share. If the high assumptions were to come true, it would even be worth that much. That basically assumes you're making 10% a year from today forward, compounding to get to that 193 to 388 a share. So to pay 120 a share to 240, we're assuming, the lower assumptions come true. Buying around 120 a share is probably a fair price if those low assumptions come true, but we don't want to buy at the fair price. We want to buy below the fair price. And today the stock is around 109 a share. So at 109, I believe we are paying a discount to the fair price with pretty low expectations going forward. For that reason, I am happy to be adding Best Buy into my portfolio. I don't think this is a massive deal or anything, but I do think it is a good price for a great company, and I plan to hold it as a value stock amongst other value companies in that portfolio. As far as TIPRANKS is concerned, the average analyst price target for 12 months out is $132.55. That represents 20.98% upside to the stock in the next year. That is 8 buy ratings, 4 hold ratings, and 1 sell rating. The highest price target for 1 year out is $157 a share, average 132, and the lowest at 100 a share. Now, I do believe that this sounds about right. I don't do 1 year price targets. I like to look at longer terms. That's why my numbers represent 5 years out. That said, I do think it's a moderate buy like TIPRANKS suggests. I don't think it's a strong buy, but I do think it is a moderate buy and it's a nice piece of the portfolio. If you enjoyed this video and you've made it to the end, please like it. It really helps the YouTube algorithm. And if you haven't subscribed to the channel, definitely subscribe. Until next time.